Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, head of research at Valkyrie. Let's take a look at the midweek market update. We have an FOMC meeting tomorrow where Jay Powell is expected to raise rates 25 basis points. The press conference itself will be rather important in light of all of the regional banking issues we're continuing to see here, especially after FRC has officially failed. And there seems to be some fear brewing, especially after today, in the regional banking sector. I hope they ask him for any plans on forward guidance, because if we're looking at the meeting probabilities here, the probabilities have officially priced out any chance of hiking past 5 to 5.25. That's certainly a statement based on what the market is saying here, reading sentiment. Now, this is no guarantee that they won't change their mind. You know, let's say, for instance, inflation stays sticky at 3 to 4 or higher than they want it on some other metrics, PCE, that sort of thing. Then they most certainly would continue raising again if regional banking, for example, calms down. But that will definitely be a very interesting press conference tomorrow. Now, like I said, raising after pausing is not out of the question, and I'm sure they will reiterate that at the meeting. This was Australia's central bank who raised rates 25 basis points unexpectedly after holding the rate previously. So, you know, anything's possible here. And Powell's probably going to say, well, you know, we may thinking about something, blah, 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 and not exactly give a play-by-play on forward guidance. But it's definitely not out of the question that if things calm down, they'll keep raising rates if the inflation picture doesn't look how they want it to look. Currently, based on real-time estimates, we're at 3.9. We've held below 4 for a little bit here. Certainly looks better than it ever has on a year-over-year basis. But obviously, if you're living here in the United States and you're feeling it, you know that inflation's still rather high, especially eating out at restaurants, or, you know, the food away from home category is quite high. And if we look at the FRC failure and add that onto SVB and SBNY, Silvergate, not on this list, technically did not require FDIC intervention. They closed voluntarily, liquidated voluntarily, paid back all deposits. That's why you don't see that on this list. There's only 3 listed here. But we have exceeded 2008 in terms of non-inflation adjusted total assets at time of failure. I believe we've also exceeded the inflation adjusted number here. And I was looking at, you know, what happened in 2008 relative to what's happening now. And we did have, you know, a second wave and a third wave as far as these bank failures. They didn't all happen all at once. They happened every couple months. We saw a big jump in, you know, total assets. And we saw a gradual increase in the number of banks that have failed throughout 2008. Now, this is excluding Lehman and Bear Stearns. I think they're in the investment banking category. That's why they're not in this type of information chart. But if we look at where we're at today, you know, we may see this continuous series of, you know, rolling type failures for whatever reason. You know, First Republic had, I think, a mixture of being close in geographic proximity to the SVB situation. There was a lot of unease there from uninsured deposits. They said that they lost $100 billion in deposits very quickly. They were holding a bunch of interest-only mortgages that they couldn't make profitable quickly enough. And I'm sure we'll get the full report on how FRC failed within the next month or two. But this was not a crypto business issue. This was not a you know, VC on Twitter screaming fire in a theater type situation. This was a very slow rolling problem that really got kicked off after the earnings report that hit, I think, a week ago. And today we had a down day, significant down day on the regional banking ETF, KRE. I'm sure there are a bunch of different regional banking ETFs. This is just one I'm the most familiar with. And again, if we look at even the COVID levels, you know, we're within that range. Just, you know, if we apply some technicals here, because why not? It's a chart. This didn't bottom overnight. It took months to bottom post-COVID, as did most things. But even before that, you know, I'd argue when you see this type of head and shoulders fractal, which is what I'm going to call it, you have an extreme high flanked by, you know, 2 shoulders effectively. It's not textbook, it's not perfect, but it certainly hints at just the possibility of bearishness here, okay? So it's why, this type of thing is why I say, look, if you see something, then use your gut instinct, because even if it doesn't cookie cutter fit, an image, it's not pareidolia. It can certainly help you understand where sentiment is in the market. But in any effect, this thing looks like it's got quite some time until it finds the bottom, just based on technicals, And if we look at some of the constituents, all 143 constituents in KRE were down negative today. Looking at one in particular, I'm not, pointing out PacWest for any specific reason other than they just had an earnings report as well. They were down significantly today. And looking into it, these are the type of language that, I'm no banking expert, but this is the type of language that to me is concerning, because they are seeking help through BTFP, they're seeking help through FHLB, and additional means beyond that, totaling 10 billion. So is there a stigma to seek help? Of course there is, but they wouldn't seek help if they didn't need to. So there are some duration mismatch issues here. There are some deposit issues, not in PacWest specifically, but just regional banking generally, and that's not even considering commercial real estate issues that will potentially crop up here over the next couple months. So it feels to me as though the market is suggesting we have a long road ahead to fix this problem. Now, they've talked about increasing FDIC limits just yesterday. They may have to act rather quickly on that if they mean it, because deposits are continuing to leave regional banks. And days like today certainly don't help deposits stay in the door when we're seeing negative 30 to 50% in stock prices on a single day. And looking at the S&P, the S&P's been quite bipolar over the past week because it was very excited on the tech earnings. It was up, the past 2 days. And then today there's regional banking stuff really got much worse, and the S&P reversed quite a bit. At this point, based on technicals, I would get concerned if we breached 4040, which is basically the current local low. We made a series of higher lows. We've been above the 200-day moving average, which isn't on here. We've been above the diagonal. This move to 4,500 plus has no basis in reality per se, other than, I'd say this is the opposite fractal of what you're seeing potentially on stuff like KRE, where I can't be bearish on this, just knowing that there's a possibility that there's clearly bullish momentum here, over time. But a breach of 4040 would reverse that. So people will definitely be watching that tomorrow into the meeting as well. And of course, DXY, continue to watch that. Hasn't moved really in the past 2 or 3 weeks. Generally doesn't move very quickly when it does move, historically. Historically it's more like 2019, where it just takes its sweet old time to do anything. It's not really common to see this parabolic rise in DXY. But in any event, the S&P is waiting on DXY to make a decision, which is sort of waiting on the Fed to make a decision on rates, and gold as well, which was up today, had a great green day on the regional banking fears. This is a 3-day chart, but right back at all-time high retest territory. And this should not be bearish. Again, just instant reaction to charts that look like this are continuation. It's got a decade cup and handle on here. If you zoom way out, it's got all sorts of double bottom type fractals here. And it's not always all about chart patterns. It's just that's where we are, in the market. And gold still looks like it wants to go higher. If we look at some on-chain stuff for Bitcoin and ETH, we have an interesting economy on the on-chain side for Bitcoin, because active addresses have turned down slightly, well within the range here. Active addresses are just addresses that have changed in value from the previous day. Probably a more powerful metric than transactions per day, at least for Bitcoin. And you can see throughout 2017, 2016, 2018, we had a continuous rise in on-chain activity. That is the fundamental bedrock for any good bullish trend, is continuation in activity use, not just speculation. Now, we do have Lightning to consider, which is very hard to measure, if impossible, the true total number of transactions that happen on Lightning. But those also have addresses that change value. Now, if we look at transactions, though, transactions per day, this is no average, this is just day over day here, has hit a mega massive all-time high. And there's a lot of NFT type speculation going on the chain that's really divided the community as far as, is it graffiti? Is it meaningful? Should we push this to a layer 2? I think eventually it will get pushed to a layer 2. Right now it is not significant enough as far as impacting the fee market to really matter. Fees are on the rise, averaging about $2 to $3 per transaction in dollar terms. But we're not seeing the fee pressures we saw in 2017, 2018, where we saw $50 transaction costs, $100 transaction, $200, right? We're not seeing that just yet. And if we dig deeper on these transactions, we look at the costs associated with those transactions. As a user, you can add any cost you want to a transaction, and the network will decide essentially if it approves that transaction or not. Now, if you want to send a transaction quickly, you will choose the highest fee that makes sense, so you are sure that the transaction gets confirmed. Now, if you aren't time sensitive or you don't necessarily care about that specific transaction being confirmed immediately within the next 10 minutes, let's say, right, being in the next block, you can move your transaction cost down essentially to zero, right? Now, there has to be very little activity on the network in order for the 0 sat per byte transactions to get confirmed, but it does happen from time to time where you see, a lull in activity, and those eventually get picked up by the network. But a majority of the transactions we're seeing recently on that rise has been very low sat per byte, very low priority. That's what they're signaling transactions. And again, these are related to NFTs called BRC20 or ordinals, whatever you want to call them. It's perfectly fine to do within the protocol and allowable. So it's hard to be against them because the technology is there. So if the community wants that to change, there will be a governance vote, a debate, and that's how we got any previous change on Bitcoin. But I think we're far from changing anything just yet. But this is early days and signs that we may be changing things in the code to push this to layer 2, for example. I'd love to see this stuff on Lightning. It makes a lot more sense, or some other type of layer 2. I don't even know if this is viable on Lightning per se, but some layer 2 would make more sense than layer 1, at least in my eyes. Hash rate has continued to rise, down slightly over the past week, but all in all, miners are still seeing profitability here, still adding hash rate, building out infrastructure, regardless of sort of a hostile regulatory environment in the US. State by state that changes, but broadly, miners have seen their fair share of flack for the amount of electricity they're using without people necessarily understanding where that electricity is coming from, how it's helping build out green infrastructure, how it's helping keep things like carbon neutral electricity and nuclear online, incentivizing that sort of thing, bringing jobs back to rural America in the Rust Belt. So the positives here certainly outweigh the negatives for me as far as hash rate is concerned, specifically in the US. So even with price up just modestly, we're continuing to see more hash rate get deployed. If we look at technicals here for Bitcoin, we are above the 20-week moving average, this yellow line here, which historically has been important for trend, and we're definitely above the daily cloud, which also is definitely historically very important for bull or bear trend. And again, gut feeling is the 20-week moving average is strong support. The Kijun, this red line, is strong support. And you can see what happened when SVB failed in the weekend. SVB depositors got made whole and how price reacted at that level there. So I'm not closing that window quite yet as a possibility for a retracement to 24, 25. But with the banking crisis over the past week, Bitcoin has been quite volatile. It was down significantly yesterday, up, recovering half of that down move today. And really in the near term, this is my most concerning chart because, if you're bearish, you're looking at this just like those KRE charts, just like an inverted S&P chart on the daily. We're getting an extreme high flanked by lower highs, not perfect, not textbook. Very few people would probably consider this a head and shoulders. I'd consider it a variant of a head and shoulders. So what I don't want to see is any more lower lows here. I don't want to see a breach of 27,000. And what you want to see is higher highs. It's kind of not rocket science. We've seen some low liquidity shenanigans go on over the past week, and hopefully that's behind us now, but we will definitely see a tremor when FOMC comes out, even though everyone knows what that rate's probably going to be and what the direction's probably going to be. You're still going to see a reaction here. Moving on to ETH, much more muted on-chain activity, transactions sort of curling down on-chain, active addresses as well, sort of curling down on-chain. And I think a lot of the ETH-related activity is moving to layer 2s, which are more centralized but do have higher throughput. That's the trade-off there. And we can look at, if we look at Optimism, Arbitrum, ETH, and Polygon as a group, ETH in the gray here, Arbitrum certainly gaining a significant amount of daily transactions, active addresses, Optimism kind of falling off here, Polygon falling off slightly. But if we look at the value capture, again, you can see Arbitrum slowly picking up steam relative to total fees, and revenues across the board kind of flat. Each of these chains has their own coin as well, so in my eyes, that does compete with Ethereum directly. The benefit of Lightning on Bitcoin is that it uses Bitcoin. It doesn't use some other token, and that's really the difference, and maybe the greatest difference maker between ETH-related EVM layer 2s and Bitcoin layer 2s. Looking at the ROI for a validator for ETH on staking, still at its really nadir lowest point, 4.27% on an annual basis. And we're not really seeing a ton of deposits here as a whole. We are seeing some exits from Binance validators, Kraken validators, and most of that's going to Lido or other sort of, I'll say, offshore, decentralized type of validator services. And in aggregate, we've seen outflows of 349,000 ETH. And on top of all that, we're not seeing ETH burn a ton of ETH just yet. It is rising here, but relative to what was happening in 2021 and 2022, when everyone was sort of postulating, this is what the burn could look like after proof of stake, we're not quite there yet on the on-chain activity side of things for ETH. And I think a lot of that's reflecting in price, because price really has done not much since March. It's really within the range, retraced quite a bit from the post ETH stake unlock honeymoon, and is just kind of hanging out down here. And again, I get these head and shoulders vibes of, you don't want to see lower lows here because you do risk spilling quite a bit lower at around 1550, just based on a chart pattern. And interestingly enough, when you look at the volume for these types of patterns, you want to see this descending volume for any chart pattern. You don't see that here. So again, not textbook, not perfect. This pattern, however, is very reminiscent to me of ETH BTC, where you're getting a type of diamond top, double top, nothing bullish. That's the thing, right? You can call this whatever you want, but I can't stretch this anymore and say, yeah, this looks decently bullish. And the time for me to own ETH is when ETH BTC is above 0.08. But until then, it may be time to have a non-ETH denominated mental picture, because ETH BTC may continue to grind lower here until activity returns back to Ethereum, back to that on-chain level it saw during the DeFi craze, during the NFT craze. All that stuff's still there. It's just very, very muted relative to what was going on in 2021 and 2022. That's all for this one. This video is for informational purposes only, and the opinions expressed are not financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.